And we are back with another episode of the AccounTalk Cast where we relate accounting to business for everyday entrepreneurs. Now, I came across this bank that was stating that they would save you 15.3% on taxes. Now, the spinoff with this bank was just that they would track your transactions. So there wasn't really any special tax savings or credit or deduction built in, but the idea behind this is that as a Schedule C tax filer or single member LLC, you pay 15.3% self-employment tax, aka payroll tax, on your profits. Payroll tax is Social Security plus Medicare. Now, SE would include the employer and employee portion of it, whereas a regular W-2 employee just pays the employee portion and then the employer pays the employer portion, right? So how can you easily lower this number of self-employment tax? Well, spend more money, have more qualified business expenses, and you'll have less profit. Do be mindful that as a Schedule C filer, paying yourself is not a qualified business expense. Now, the amount of tax that you owe is based on your taxable income, right? So with that being said, I think the goal of every business owner to pay no taxes would be to maximize their deductions to get their taxable income as low as possible and maximize your credits because credits are basically dollar for dollar tax payments. Now, let's get back to the self-employment topic. To save 15.3% on taxes as a single member LLC or a Schedule C filer simply is to invest more in your business and take advantage of the credits that are built into the tax law. Now, another way to legally avoid self-employment tax, which most of us may have heard of, is to become an S Corp. One of the benefits of an LLC is the ability to elect how you are taxed in the eyes of the IRS. S Corps do not pay self-employment tax, nor do they pay any corporate tax, but rather the profits pass through to the owners and taxes are paid on the individual level. Now there's a catch. Many S Corp owners may be in for a surprise if they are failing to provide a reasonable compensation to their S Corp owner, employees / operators. Now, reasonable compensation needs to be run through payroll. That means that they are going to be paying that 15.3%, right? But the idea is that we are doing a reasonable amount. The remainder of our profit gets to pass through, avoiding the 15.3% on self-employment tax. So remember that the self-employment tax, again, is 7.65% the tax that employees pay and 7.6% that the employer pays for Social Security and Medicare, right? 7.65 employee, 7.65 employer, collectively would be 15.3. That is what we call payroll tax. So yes, if you are an S Corp owner, you will save 15.3% on taxes if and only if you are properly taking a reasonable compensation, paying the payroll tax there, and then having the remainder of your profits run through as a distribution. I appreciate you joining me for this episode. If you have any questions, go ahead and send me a DM on Instagram at DionRincon, or you can feel free to drop them in the comments below. Thank you for your time, and I hope to see you on the next one.